Hi, everybody. Welcome to the second Afronomics Law Indaba. For this session, I'm delighted to introduce my very good friend, Duncan Kiara, who was my senior at the School of Law at the University of Nairobi. He is now the Chief Counsel at the World Bank's Legal Vice Presidency on Development Finance. He leads a team of dedicated legal professionals at the bank who provide legal, policy, and operational advice and support to internal and external clients and other stakeholders on a wide range of resource mobilization and innovating financing platforms, one of which we'll be talking about today, which is trust funds. He joined the World Bank in 2005 after working for several years for regional international financial institutions, and in particular, I believe the African Development Bank, a securities exchange and law practice in Nairobi, Kenya. His areas of expertise include corporate finance, derivatives, securities regulation, and tax law. As I said, he's a graduate of the University of Nairobi, one of the top students there I know for sure. The University of Cambridge, Columbia University Law School. He's an advocate of the High Court of Kenya and a member of the New York Bar. And he's also an adjunct professor at the American University College of Law. So I know that there are many things, Duncan, that I have omitted in your bio. So maybe you could begin by filling in the gaps before we get our conversation going.
Well, thank you very much, James. I'm delighted to be here. I'm honored by the invitation to come and share and speak with you all on the topics that we will cover today. I don't think you've left anything out of my bio. I think that was very comprehensive. I almost didn't recognize myself there, but thank you again for the introduction, and happy to continue and have the discussion that we're scheduled to have.
Yeah. So thank you very much. I think one of the reasons that I thought that this conversation would be a great one for our viewers or readers at Afronomics Law. First of all, it's just seeing Duncan Kiara. I think that our readers, our viewers need to see lots of people like you who are doing very important work, especially in the transactional space. There are lots of Africans who are working at the WTO and other places, sort of doing the regulatory work in the international space. I think there may be fewer people like you in the transactional space at the very high level. So it's good to have your voice and to learn from you. So I think that one of the first initial questions is about trust funds as development finance vehicles. So if you could tell us what these are, what their strengths are, for example, as a form of concessional financing, their approval processes, and how they differ from the traditional mechanisms for financing development.
Sure. Thank you again, and happy to have a discussion around that. I'll start with a disclaimer, and I'm assuming most of our audience, if not all of it, will be made up of lawyers. So hopefully they will understand this. That I think in the course of the discussion we'll have today, the views I present will be my own. Right? I will not be speaking on behalf of the World Bank or the African Development Bank or any of the other institutions that I've been affiliated with currently or in the past. So getting that out of the way, let's talk about trust funds first of all as a development vehicle and what they are. And at the basic level, a trust fund is essentially a financing instrument where donors provide resources to a multilateral development institution. And during our discussion, when I refer to multilateral development institutions or multilateral development banks, I'll be talking or looking primarily at the World Bank and the African Development Bank. The World Bank being made up of the International Bank for Reconstruction and Development and the International Development Association. And so donors will commit resources, give resources to these institutions for them to manage as trustee and for them to use those resources as a complement to the regular resources that these institutions provide for development financing to their clients. So they are a platform for financial collaboration, for knowledge sharing between donors, client countries, and other stakeholders, other institutions that may be involved in that area. And they provide a collaborative platform at the global level, at regional levels, and at country levels as well. And broadly speaking, there are two types of trust funds that I'll be speaking to, which is what we call regular trust funds, and I'll go into a little bit more detail about what these are, and what we call financial intermediary funds. Regular trust funds are used to provide grants primarily, but can also provide loans and guarantees to recipients for purposes of financing development operations, development projects or programs in client countries. And they are administered, those resources that go into a trust fund, are administered in accordance with the regular policies and procedures of the multilateral development banks. The easiest way of understanding this is that the same policies and procedures that would apply to the financing that comes out of the development bank's own resources would also apply to financing provided out of a trust fund's resources, where we're talking about regular trust funds. And so they will complement the multilateral development bank's own financing for projects that are financed in client countries. They're also very often used, and this is a growing area, they're also very often used to augment the development bank's own budget and budget financed activities. And here I'm speaking primarily about, knowledge products, whatever analytical work these multilateral development banks are undertaking. They will supplement and they will use trust fund resources to help finance this analytical and advisory work. And regular trust funds are also used to provide assistance to member countries to facilitate debt reduction, which is one of the things we will speak about a little later when we talk about debt relief. So that's regular trust funds. Financial intermediary funds are of a type of trust fund that's primarily found within the World Bank's architecture. And they provide, what the World Bank does there is it provides tailored operational, administrative, and financial services to these financial intermediary funds. And where that the structure of a financial intermediary fund, what we call for shorthand a FIF, differs from a trust fund is that we're providing a more limited suite of services, and they're more highly tailored. We're providing a limited trustee role in the sense that we are, in some respects, simply holding and managing assets that we then transfer at the direction of an independent governing body that oversees the activities of the financial intermediary fund, as opposed to a regular trust fund where it is housed entirely within the organization and the organizational framework of the Multilateral Development Bank. The FIFs have an independent governance body that oversees most of its activities. The World Bank can play a number of different roles. In addition to being limited trustee, it can also be what we call an implementing agency, where the World Bank will receive funds from the FIF as a complement to its own financing. The World Bank also sometimes acts and supports the Secretariat, hosts the Secretariat for the FIF. Not in all cases, but in a number of instances, it is host to the Secretariat. So broadly speaking, that's the universe of trust funds as we know them, as they are found within the multilateral development banking space. So what are their strengths? And I think we can break that down into three large buckets. They're a growing part of and a growing source of development finance. There's, by some estimates, the gap, the development financing gap to achieve the United Nations Sustainable Development Goals is in the order of between $3 and $5 trillion. The entirety of the multilateral development banks cannot fill that gap and cannot raise that financing on their own. And so trust funds help close that gap by leveraging resources, by helping governments build their capacity to mobilize financing, mobilize revenue, manage public expenditure, and the like. And they support the development of innovative development solutions, innovative financial solutions to development challenges, and they mobilize additional non-traditional sources of finance, if you like. So that's one bucket that's one of the strengths. It's the ability to leverage. It's the additional financing that they bring to the table. The second and big, I think, strength, the second big advantage that trust funds provide, I think, is their complementarity that they bring to the financing and the development activities that are funded out of the regular resources of the multilateral development banks. And this is, again, at the global, the regional, and the country level. They provide funding to countries and clients that, in many cases, the multilateral development banks cannot themselves finance, either as a result of policy restrictions or as a result of limitations in the articles and in the constituted documents of these organizations. As I mentioned earlier on, they will support the analytical work of the multilateral development banks, and they make it possible for some of these multilaterals to also provide financing to countries or to territories that these multilaterals cannot finance out of their own regular resources. Countries that may be in arrears to these institutions and therefore can't, as a policy matter, receive financing from the multilateral development bank directly, or in some cases financing to non-sovereign institutions. A number of the banks have limitations as to the types of clients that they can provide financing directly to. The trust funds help bridge that gap and help provide financing to institutions or to recipients that would not otherwise be eligible to receive financing directly from the MDBs. And then thirdly, the trust funds allow the multilateral institutions to take the lead on global issues. We found over time that countries are reluctant, and understandably so, to borrow funds to finance global public goods, or what are sometimes called global public bads. So if you think, for example, about climate change, whereas a country could borrow to finance that, where there's a sense that they will bear the costs, the entirety and the burden of the costs alone, but the benefits will be more broadly shared, there's a reluctance to bear the full weight of that cost on their own. So where a trust fund is able to provide grant financing to fill and to support activities and development programs in that area, that has incentivized countries to, in fact, invest in areas like renewable energy, energy efficiency, climate resilience, and so on. So those would be, in my view, the three biggest value adds, if you like, the trust funds bring to the development finance space. do you want me to then go on into a quick discussion on the risks, or
Yeah,
do you want
yes, that would be great. And in that context, if you could, in answering the question about the risks that they pose, if you could also give examples of some of the kinds of territories that there might be restrictions in other funding mechanisms of the bank that the trust funds are ideal for. And if you could also, in also doing that, tell us whether the relationship between the point you made earlier about the trust funds being governed under the regular policies and procedures of the bank relative to the point you made about the strengths of the trust funds being that they allow flexibility for financing where there may be restrictions that a territory or a country that's a member of the bank may be facing. And I know that a lot of the people who are more familiar with the World Bank, we tend to think more of the conditionalities and in that language. So I wanted to make sure that I mentioned that so that you could say something, if you could, about that.
Sure, happy to. Maybe let me take that first, and then we can speak briefly about where the challenges are and what challenges are presented by the trust fund framework, if you like, or the trust fund financing. So when I refer to the flexibility that trust funds provide in terms of allowing institutions to go into places or provide financing to entities that others would not be eligible. One quick example that immediately comes to mind is financing to an entity or a territory like South Sudan. Now, under the constitutive documents of an institution like the World Bank, and here I'll talk specifically about IDA, the International Development Association, although the provisions are almost exactly the same between the IDA and the IBRD. IDA's articles require that financing from the institution is provided only to members and territories that are part of a member of the World Bank. Now, when South Sudan was in the process of independence from Sudan, it was clear that it would need a significant amount of development assistance to help with the transition and to help it begin its journey as an independent country. But there was a legal problem. There was a legal restriction, a legal limitation to the institution providing financing directly to South Sudan. Over time, there is a mechanism has been developed within these institutions that allows financing to come from a donor into a trust fund that can then provide financing to a territory that has emerged from another member and that is in the process of seeking its own admission and its own membership in the institutions. And that was a mechanism that was used to then provide financing at the outset to South Sudan. It couldn't get financing directly from the resources of the institutions until it became a full-fledged member. But in the interim, we were able to provide financing out of donor resources that we administered with the understanding that this is for the benefit of the membership as a whole, the membership of the World Bank as a whole, and that Sudan was in the process of becoming a member of these institutions. We've had a similar approach taken in Kosovo, for example, when Kosovo was in the process of independence. And we take a similar approach with territory like West Bank and Gaza. So those are, it's that it's through that lens and with that in mind that we see that one of the true benefits of trust fund financing and the flexibility that it brings to the financing of development needs provided by the banks. So if that answers that question, let me just briefly touch on what the challenges are with trust fund financing, and I think they can be broken down again into two broad buckets. I think as has hopefully become clear, what trust funds enable donors and clients and the banks to do is to provide targeted resources in specific sectors or specific geographical regions for development finance. But that has also been perceived in some quarters as allowing donors to exert influence then in an informal way that alters the behavior of either other donors or of multilateral institutions in order to allow the donors to effectively push their own priorities. And organizations that are heavily dependent on bilateral financing of this nature have perhaps been the ones that have been most susceptible to what's perceived to be this what's often called, I think, priority divergence, if you like. The United Nations, I think, is one good example, and it's often because of its dependence on bilateral financing. It has structural features that allow or that make it even more susceptible to this donor influence. And it's clear that donors will, as they should be allowed to, will be looking to direct their financing, their ODA, their development assistance to areas that are within their own priorities, within their own that they see to be of significance and of importance to their own taxpayers. And this has led to some scholars arguing that this has a potential to undermine multilateralism writ large, to undermine the governance of the multilateral development banks themselves. And I will touch on this a little bit later. There are measures that have been put in place to help mitigate that risk and that perception of that risk through trust fund reforms that these multilateral institutions have enacted over the years, particularly as trust funds have accounted for greater shares of multilateral institutions' budgets and multilateral development fund finance that's provided. Related to that, and this is, I think, a factor that is particularly is probably a lot more limited to the financial intermediary funds that I just described earlier on, is a sense that the FIFs, because of the more independent nature that they have, the fact that they have an independent governance body, present particular fiduciary and reputational risks to the multilateral development banks, because they've got an independent governance body, even where there's a role played by the multilateral development bank. There's a risk that the decisions or the focus of the independent governance body may be misaligned with the priorities and with the operations of the multilateral development bank that's hosting or supporting the particular FIF. Now, my own sense is there are instances where that risk has perhaps materialized in more than others. But at the same time, there has been a concerted effort, I think, by these institutions in consultation with the donors to address that, because I think there is a generally held and hopefully will be held for a long time. There's a generally held view that multilateralism is critical. It's critical to addressing development challenges. It should be the primary vehicle for channeling development resources through multilateral institutions, and that bilateral financing through trust funds should be a secondary, complementary channel for providing development finance. And so through a number of reforms that have been put in place over the years, the multilateral development banks and the donors have agreed to more closely align the objectives of the FIFs and the trust funds to the strategic objectives of the multilateral development banks. Make sure that there is no mandate divergence, if you like, and ensure that the roles of the governance bodies, the roles of the multilateral development banks, the roles of the recipients are all very clearly defined within these structures. So there's no overlap that could be a source for confusion or heightening of the risk that I've just described. So that, I think, broadly speaking, captures the primary risks, I think, or primary challenges that we face in managing these resources that are channeled through trust funds.
Great. I mean, so this is great. I mean, I think that particularly for our viewers and readers who are very interested in the work of the World Bank and other institutions like the World Bank, I think this ought to be increasingly part of their research agenda. So it's good that you're giving us lots of information that we can follow up on. I guess to even make this more concrete, I think the other major topic we'd agree that you'd address is the work of the trust funds in the context of COVID-19 and global health. And perhaps here you could also say something. I think you've emphasized the role of bilateral donors who are contributing to the trust funds. And I guess here, I think many people might associate this with groups like the Bill and Melinda Gates Foundation and others. Perhaps you could say something about that as well.
Sure, and happy to. So it is, and I think this will be well understood, I think, by everyone. The impact that COVID has had, I think, on everyone, in terms of the economic and social shocks that it has led to, the health crisis that it has precipitated are possibly cannot be overstated. And as it turns out, the largest single sector within, certainly within the World Bank, that is funded by external resources. External resources is, again, referring to trust funds, both regular trust funds and FIFs, is the health sector. And within the FIF universe, close to 50% of all the FIF resources that are held by the bank are held for FIFs in the health sector. And so we're talking about something in the order of about 45 billion, closer to $48 billion. And I'd like to quickly highlight four FIFs and trust funds that have been particularly close to the COVID-19 and financing COVID-19 responses, and that are all part of the health sector, as it were. The largest fifth that the bank supports is the Global Fund to fight AIDS, tuberculosis, and malaria, what we simply call in shorthand the Global Fund. And it accounts for nearly 42% of all the fifth resources that we have under management currently. It was established in 2000 as a partnership of governments, civil society, private sector players, technical agencies, and people affected by those three diseases, by AIDS, tuberculosis, and malaria. And it pools resources to invest strategically in programs that are designed to end these three diseases. And it mobilizes about $4 billion a year to do so. Now, in response to the COVID-19 pandemic, has established what they call the COVID-19 response mechanism, which supports countries in responding and managing the impact, mitigating the impact that COVID-19 has had on the malaria, TB, and AIDS programs, and initiating urgent improvements in health and community systems to respond to that impact. That facility was seeded with about $500 million at the outset. It has, and our expectation is it will continue to grow, and we will see this happen, I think, across all the players in the sector. Will continue to mobilize and seek to mobilize resources to address not just the three core diseases that it's looking at, but addressing the impact that COVID has had as well, more broadly. The other organization that is supported by the World Bank through a fifth is the International Financing Facility for Immunization, which was founded in 2006. And again, very, very much like the Global Fund, brings together private investors, private sector players, and government donors to accelerate the delivery of vaccines by essentially making long-term pledges from countries, from donor agencies, from donor countries, immediately available to the Vaccine Alliance for it to finance immunizations for children. And it does this by taking those donor pledges and issuing bonds backed by those donor pledges effectively, and using those resources it generates to channel through the Global Vaccine Alliance that is involved with the Gates Foundation. And it has raised, IFIM has raised $6.5 billion over the last 14 or so years to help immunize close to 800 million children and prevent, by its estimates, the death of about 3 million children. Now, recently, IFIM has issued a bond of 2 billion Norwegian krona to accelerate the availability of financing for the development of COVID-19 vaccines. And that money, the 2 billion Norwegian krona, has been channeled to another entity that is supported by a fifth within the World Bank. That entity is called the Coalition for Epidemic Preparedness Innovations, CEPI for short. And CEPI was established in 2017 as a global partnership again between the private sector and the public sector, philanthropic and civil society organizations, to develop vaccines to stop future epidemics, and ensure equitable access to these vaccines by people during the course of an epidemic or an outbreak. Now, CEPI estimates that it will require that the development of 3 COVID-19 vaccines will require about $2 billion of investment over the next 12 to 18 months. And that cost, the $2 billion, factors in the cost of clinical trials. The expectation is that they would start with 8 vaccines, and then through the clinical trials settle on 3 that would then be taken through quality testing, quality control, get the regulatory approvals that are needed, and then get it ready for manufacturing. But that $2 billion does not include the actual cost of manufacture and delivery of those vaccines. That would require alternative sources of financing, which are also being explored at this point. The bank hosts a couple of other, one other FIF and a trust fund that I'll quickly just speak to, that are also, again, that have had, that are either designed to address epidemics largely, or have been set up specifically to provide financing, in rapid financing in the event of an outbreak. So there is the Pandemic Emergency Financing Facility, which is PEF for short. We love our acronyms in the development finance space.
Great.
it can be a bit of an alphabet soup. But the PEF is housed within the World Bank, and was established following the Ebola outbreak. And through innovative financing mechanisms and the use of parametric triggers, it provides rapidly disbursing financing during an outbreak cycle. It provided a significant amounts of financing to DRC during the Ebola outbreak, and it does cover coronaviruses, and one of those being COVID-19. Has resulted, once the parametric triggers for providing financing were hit. The PEF did provide back in April close to $200 million to 64 countries which had reported cases of COVID-19 to provide financing with special attention being paid to the most vulnerable populations, particularly those in fragile and conflict-afflicted countries. Finally, I just quickly mention one of the newest trust funds in the development space, called the Health Emergency Preparedness and Response Facility, which was set up in April with a significant contribution from Japan. Which will seek to help countries respond to public health emergencies, which would include the current ongoing COVID pandemic, and help them increase investments in health preparedness and in responses by offering grants for a variety of activities, including for operations geared towards prevention, detection, and building up response mechanisms to the impacts that these crises, this health crisis in general and the COVID crisis in particular have caused.
Great. So these are great examples of these financial intermediary funds, the FIFs, and I wonder, to set up our last question, whether you can say an additional word about whether any of these 4 examples that you gave us, I think the last one you made clear they are grants, whether any of them are loans, whether they're all structured as grants. Let's set up our final question about the issues relating to indebtedness, sovereign indebtedness.
Right. The financing provided from all these that I have referenced is all in the form of grants. So the financing that they give to recipients is entirely in the form of grants. It's all grant financing. So there is no obligation on the parts of the recipients to repay any of these funds. And this is true broadly for the vast majority of the trust fund financing that is given. There's only there's a very small subset of trust funds and financial intermediary funds that provide financing in the form of loans. The vast majority of the financing provided through this mechanism is in the form of grants.
Great. So that's really great. I think you have set, at least as far as I'm concerned, a whole new research agenda to understand more fully these new financing mechanisms that I don't think have been sort of at the center of attention. And finally, I wonder whether you would tell us anything relating to the transactional issue, since that's your expertise in the context of sovereign debt and the growing indebtedness of African countries and other countries in general. And you may decide to focus first and foremost, of course, on the indebtedness that arises in light of the loans from multilateral development banks like the World Bank, and if you have anything to say about other types of sovereign lenders, that would be great as well. And so that this is our last discussion.
Sure. So I will touch on debt relief and the role that the multilateral institutions, I think, have played over the years in the provision of debt relief, both with respect to bilateral public debt, multilateral and bilateral public debt, and briefly on private sector debt too. And the multilateral institutions have been heavily involved in this space, going back to the 1996, when the Heavily Indebted Poor Countries Initiative, HIPIC, was launched by the World Bank and the IMF in response to the accumulation of unsustainable developing country debt in the period between the start of the 70s and through the 1980s. And what HIPIC called for was for voluntary debt relief from all creditors, right? Public and private, to give eligible countries a fresh start on foreign debt that had placed too great a burden on their economies and on their resources for debt service. It turned out that wasn't enough. And in 2006, recognizing that countries that had graduated from HIPIC, had received debt relief from HIPIC, were still struggling to make progress towards meeting the then Millennium Development Goals, and the multilaterals launched a second phase of relief that was called the Multilateral Debt Relief Initiative, MDRI, which offered full debt relief from the World Bank, the IMF, the African Development Bank, and the Inter-American Development Bank for low-income countries that had completed the HIPIC process. And combined, the HIPIC and the MDRI initiatives have provided close to $100 billion of debt relief over the last 25 years or so. Aside from that, from those two major initiatives, the World Bank has also launched and supported a debt reduction facility, which was launched in the late 80s, in 1989, which provides grant funding to eligible governments to allow them to buy back at a very deep discount debts owed to external commercial creditors. The debt reduction facility was conceived as part of the special program of assistance for low-income debt-distressed countries in sub-Saharan Africa. And since its inception, it has supported 25 buyback operations in 22 IDA-only countries. So in 22 countries that receive or that are eligible to receive financing from IDA. These operations, these 25 operations have extinguished about $10.5 billion of external commercial debt principal and about $3.5 billion of associated interest and penalties. And again, this is at a fraction of the par value of the commercial debt that it was extinguishing. Now, it did this through the provision of two types of grants, preparation grants that supported recipients recruit or retain legal and financial advisors to prepare the commercial debt reduction operations, and implementation grants that helped finance the cost of those operations. Now, the vast majority of recipients and beneficiaries of these debt reduction operations have been, again, sub-Saharan African countries. In addition to the actual financing of debt reduction operations, there is a facility that was established under the auspices of the African Development Bank, known as the African Legal Support Facility, that was established in 2008, that was designed to help address the asymmetries that are often faced by African countries when it comes to negotiating transactions with creditors, banks, and other financiers, and also that comes from litigation that may arise in resolving disputes related to these agreements with external financiers. So the ALSF provides advisory services to improve the negotiation capacities and capabilities of its member countries by focusing on three priority areas: strengthening legal expertise and negotiating capacity, particularly in the areas of natural resources, extractives and extractive industries, investment agreements, and public-private partnerships. It also supports and provides financial resources to obtain legal assistance for negotiation and settlement of commercial disputes, and provides capacity building and knowledge management. And since its establishment up to 2018, it has provided 40 countries with a total of about, and these are all African countries, a total of about $75 million worth of support through 192 operations. So it's been particularly successful, I think, in helping support and bridge the capacity gap that a lot of African countries face when negotiating with developers, with project sponsors, with financiers from outside their respective countries. And then lastly, I'd just like to quickly mention the Debt Service Suspension Initiative, which was launched by the G20 and the World Bank's Development Committee earlier on this year to support developing countries in helping them manage the severe impact of the COVID-19 pandemic again. And what this initiative seeks to do is to grant a debt moratorium or a suspension of payment of debt service for a period of 3 years to alleviate the pressure on the fiscal positions of many of the poorer countries, with the expectation and the understanding that that fiscal space that is created and the resources that are freed up by the debt suspension will be used and committed to increasing social health and economic spending in response to the crisis. Beneficiaries also commit to being more transparent and disclosing more public sector debt, and to be more prudent about their non-concessional borrowing. Now, it is voluntary participation in the DSSI. The Debt Service Suspension Initiative is voluntary. There are about 73 countries that have participated up to date, and 67% of those are African countries. It will take a while to see, and the monitoring mechanism being put in place to ensure that it is being used for the purposes intended, and that the resources freed up are flowing to these sectors that are designed to help mitigate the impact of COVID. But the rate of uptake has been promising, and we're hopeful that the benefits will be seen and realized by the countries that have elected to participate in the initiative. So I'll just leave it at that in terms of the debt relief initiatives that the multilaterals have participated, that they have sponsored or participated in over the years to help address the pressures of unsustainable debt in their client countries.
Great. I mean, I think that that's a great overview, just like you gave us with the trust funds. I mean, I think that one of the most important points you make is the importance of there being resources to provide these countries with the legal and financial advisory services necessary to turn into reality the commitments that are made for debt relief, such as under the DSSI, the Debt Service Suspension Initiative. I think that, and I think you make a very good point about the African Development Banks, the ASLF facility as well, and the number of countries that are taking advantage of that facility. So I guess, I wonder, I think that in the space of the multilateral development banks, I think there's been a lot of activity there. There's been much less, I guess, in the area of the private lenders. And I know this is not your area of expertise, but I had promised that I might raise this. And I wonder what advice that, in light of the experience that you've just alluded to, and for me, the most striking of this that we often don't think about is the significance of there being capacity to negotiate once the commitments are made to turn into reality the paper commitments. What advice that you'd give to African and other countries that are seeking the private creditors to make similar commitments to suspend debt service for a couple of years so that they can get the fiscal space to reallocate resources for the things that have really suffered as a result of the COVID-19 pandemic?
Right. Thank you. I think my own view is that I believe there are a couple of countries that have already taken this approach, is that there is nothing to prevent individual countries initiating a discussion or negotiation with their private sector creditors to seek similar accommodation from them to help alleviate the pressures on their economies. And initiating the debt suspension service initiative, the G20 and the World Bank did call on commercial creditors to seek to offer debt suspension on similar terms to their sovereign debtors. Now, having said that, we're also sensitive to and cognizant of the fact that the terms of commercial agreements may vary considerably from those of public sector finance, and that there may be provisions that would be triggered in the event that such an approach is made by a sovereign creditor seeking accommodation that may trigger unforeseen or unwanted consequences. So it would be imperative for any sovereign borrower to take advantage of the technical advice and the resources offered by a facility such as ALSF. Review their obligations, review their agreements with their commercial creditors to ensure that, one, there will be no unintended consequences in approaching these lenders to seek that accommodation, and two, that they're able to do that on terms that make sense for them. Beyond that, it would be very much a bilateral negotiation with the commercial creditors until such time that a broader acceptance by commercial creditors of the terms of the DSSI occurs, if ever it does occur. It has happened in the past. It's not beyond the realm of possibility that it could happen again. But as of now, the commercial creditors are not have not all jumped into and agreed to participate in the DSSI.
Great. Well, thank you very much. I think this has been a very good discussion. I really appreciate your time today, speaking to us about trust funds and what they've been able to achieve in the context of the response to COVID-19, but also in sort of our second discussion that we've had around sovereign debt and the many initiatives that the World Bank and the African Development Bank have put in place, and how those are seeking to address the many impacts that the COVID-19 pandemic has had on the economies and the ability of these governments to have the fiscal space to address their most important development needs, particularly in the health and other sectors. So I appreciate your time very much for being my guests in this second Indaba. We have a lot to learn on this side of the academic world from what you guys do, and I'm glad that you've helped to bridge this gap on some of the most important topics that you do there at the bank. I know you've spoken in your personal capacity, so you certainly, I know, are not speaking on behalf of the bank, but I appreciate very much the expertise you bring on the transactional side of all these things. And it's great we have Duncan there sort of doing this important work, and I appreciate your willingness to speak to us and to provide this important learning opportunity for us.
Thank you very much, James. It's been an honor and a pleasure to participate. I am particularly pleased, I think, with the whole initiative. I love the Indaba series. I know this is just the second one. I love the idea of it, and I fully encourage you to get more and more people involved, get more speakers willing to come and speak on a wide variety of topics that I think are of interest to all of us, to those of us from the continent, to those of us with an interest in the continent, and in the work that you and others do on areas that are of relevance to all of us. So thank you very much for having me, and I wish you all the best with this series.
Yeah. Well, thank you. You're very kind. We'll continue to seek out more people, and I know that this is taking you away from lots of things, including your weekend, and so I appreciate very much you're making time for this discussion.
Great. Thank you again.